Okay, let's continue with our risk measurements. Next is R squared, which represents another important component of our risk measurement toolkit because it provides insight into how much of the asset's movement can be explained by market movement. In statistics, R squared is a fundamental component of regression analysis. It measures the proportion of variance in the dependent variable that's explained by the independent variable. For investment purposes, R squared measures the explained movement of a fund or security in relation to a benchmark. The coefficient R represents the correlation between the investment and its benchmark, and R squared tells us what percentage of the investment's movement can be attributed to market movements. So a high R squared tells us that a portfolio's performance closely tracks the market index. For example, an R squared of 0.95 means that 95% of the market's movements can be explained, of the portfolio movements can be explained by the market movement, when only 5% are due to other factors. When used together with beta, R squared can provide a comprehensive picture of asset performance. A high beta with a high R squared indicates that the asset is highly sensitive to market movements and that this sensitivity is consistent. A high beta with a low R squared might indicate that the asset is volatile, but its movements are not well explained by market movements alone. This combination helps investors understand not just how risky an investment is, but also where that risk is coming from. Now let's look deeper into beta. It's one of the most important risk measures in modern finance. Beta measures the amount of systematic risk an individual security or sector has relative to the entire stock market. It's a measure of relative volatility, how much more or less volatile an asset is compared to the overall market. The market always serves as the beta benchmark. Every investment is compared to the market, and the market always has a beta of exactly 1 by definition. So this is how we interpret beta values. If a security has a beta of 1, then the security has exactly the same volatility profile as the broad market. So when the market goes up 10%, the security would be expected to go up 10%. When the market goes down 10%, the security would be expected to go down 10%. A security with a beta greater than 1 is more volatile than the market. If a stock has a beta of 1.5, it would be expected to move 15% when the market moves 10%. So it essentially amplifies market movements. A security with a beta less than 1%, less than 1, is less volatile than the market. So a stock with a beta of 0.5 would be expected to move only 5% when the market moves 10%. So essentially it dampens market movement. Understanding beta is very important for portfolio construction. So if you want a conservative portfolio, you focus on low beta stocks, but if you're willing to take on more risk for possibly higher return, then you might include high beta stocks. Now we move to some of the more sophisticated risk measurement methods that are widely used in professional risk management. Among the advanced risk measurement methods, we have value at risk, which is VAR for short, and some asset pricing models. These approaches are considered highly effective in estimating the correlation between risk factors and returns on assets. VAR represents a significant evolution in risk management because it attempts to answer a very practical question. What's the worst loss we might expect under normal market conditions? This is exactly the kind of question that senior management, regulators, and investors want to be answered. Asset pricing models, on the other hand, help us understand how assets should be priced given the risk characteristics. These models form the theoretical foundation for much of modern portfolio theory and risk management practice. Both VAR and asset pricing models represent sophisticated approaches that combine statistical analysis with financial theory to provide actionable insights for risk management decisions. So, value at risk, or VAR, has become one of the most important risk measures in modern finance because it provides a clear, intuitive answer to the question of potential losses. VAR methods estimate the loss for a given asset over time using a specific probability or confidence level. For example, 95% VAR tells us the loss that we would expect to exceed only 5% of the time under normal market conditions. VAR is calculated as a function of the mean and variance of the return series, making it grounded in statistical theory while remaining practically useful. Different types of VAR methods are utilized throughout the financial sector for measuring risks in portfolios. Banks use VAR for regulatory capital calculations. Portfolio managers use it for risk budgeting, and corporations use it for enterprise risk management. The key insight of VAR is that it provides a single number that summarizes the risk of a portfolio. Instead of having to analyze multiple risk measures, a portfolio manager can say, our daily VAR is $1 million at the 95th percent confidence level, which immediately communicates both the potential loss amount, which is $1 million, and the likelihood of that loss occurring, which is less than 5% probability. This simplicity and intuitive appeal have made VAR one of the most widely adopted risk measures in the financial industry. Let's examine how VAR works in practice and why it is so widely adopted by financial institutions, portfolio managers, and regulators. Over a defined period of time, VAR represents the loss that would be surpassed at some given probability level. Firms calculate this by evaluating the distribution of potential portfolio values and identifying the loss level that corresponds to their chosen confidence level. VAR methods estimate the loss for a given asset over time using a probability or confidence level, making it both statistically rigorous and practically useful for decision making. VAR is widely used by financial institutions and portfolio managers and regulators to forecast potential losses. Banks, for example, are required by international banking regulations to calculate VAR for regulatory capital purposes. Managers use VAR to ensure they're not taking on more risk than their mandates allow. Regulators use VAR to assess whether financial institutions are adequately capitalized for the risks they're taking. The widespread adoption of VAR reflects its practical utility. Unlike some academic risk measures, VAR directly addresses the concerns of practitioners. How much could we lose? And how likely is that loss? These are exactly the questions that need to be answered for effective risk management.